Hello friends, now we are going to study approach of capital structure, part of corporate issuer capital structure learning module. What we are targeting? We are targeting learning outcome number 3, that is explain the Modigliani propositions regarding capital structure. Before starting this approach, who are these guys? Modigliani and Miller, they are Nobel Prize winners, very respected, and they have given certain approaches regarding dividend policy, regarding capital structure. In case of dividend policy, it is called as dividend irrelevance theory, and in case of, interestingly, in case of capital structure, it is called as structure irrelevance theory. Franco, Modigliani and Meriton Miller, Nobel Prize winner. So why it is called as capital structure irrelevance theory? According to them, capital structure is irrelevant. Whatever capital structure you want to keep, 100% unlevered, 50-50, 70-30, or theoretically 100% debt, it's okay. It is not going to affect anyone's decision, neither issuers nor investors. Nobody is affected by the decision. So take as you wish, whatever you take decision as you wish. Interesting theory under certain assumptions, and applicable under certain assumptions. What I am going to take is, I am going to take the complete theoretical approach first, and then we are going to also solve a numerical question of approach without tax and approach with tax. We are going to calculate all the values which examiner can ask in our question in our exam. So in question paper, you may get any of these question. What is the total market value, or what is equity capitalization rate with tax or without tax? That I'm going to solve. So, but before going for, and very easy, 6-7 steps, and all questions can be done on those 6-7 steps. So before going for this numerical question, because just by learning the steps, we may not be able to understand the complete theory. So we have to first understand the theoretical aspect, and then we should move to the numerical aspect. So let's start with the theoretical approach. So this Modigliani and Miller capital structure theory, it's actually the base theory. Over and above which there are more other theories, but this gives the base starting point of the discussion for related to capital structure. Why I am saying this? Because this theory is applicable under certain assumptions and not very practical. That is why not very useful, but to begin with, yes, it's a starting point. It gives a base to base for other theories. So how we are going to study? So theory or approach is divided into two parts. First, approach is without taxes. Under this theory, the assumption is that there are no taxes in the world. I'm talking about the corporate taxes and the income tax. And the second approach is improvised, and it is called as approach with the taxes. In both the theory, there are two propositions. Proposition 1, proposition 2, proposition 1 and proposition 2 for with tax also. Very easy to learn. The proposition 1 in both the theory is related to valuation of the firm and WACC. And proposition 2 in the both the theories is related to cost of equity. What type of question we may get? Theoretical question. Number 1, they may give a statement and ask you, okay, whether it is part of the assumption or not. Number 2, it is belonging to which proposition or which theory. So these are the type of theoretical MCQs we may get. So let's take this theory without tax and then with tax one by one, and then the numerical question from both the theories point of view. Very important to go through the complete theoretical aspect, because without this, there will be always ifs and buts in the numerical question. Why we are doing this? Why we are doing this? That question we are going to get every time whenever we are going to do the numerical question, if we do not have the clue about the theory. And this theory starts with the first theory, without text, starts with the certain assumptions. So we have to study these assumptions also, because these assumptions are what we are going to use in the numerical part. So first assumption, homogeneous expectation. Obvious, in the practical market there will be always heterogeneous expectation. That is why there will be one person who is buying and the second person who is selling, because both are having different expectations. One is expecting, the buyer expecting prices to go up, and seller is expecting prices to go down. But okay, first, to start with, the first assumption is homogeneous expectation, because we have to keep certain things constant. And because of this homogeneous expectation, valuation done from Mr. A's point of view, investor A, will be always equals to the valuation done by Mr. B, investor B. Next, the second part. So what is this assumption says? All investor A and B have same expectation regarding future cash flow. Very important from valuation point of view. Reason being, what are the three steps for valuing any asset or liability, any security? First, find out the future cash flow, identify your required rate, discount those future cash flows by that required rate, and sum up all those present value. That is the value of any asset or liability in the world. This is the general the three-step way of valuing anything. So when this theory says that all investors in the market, all participants in the market have same expectation about future cash flows. So if A is expecting that a project is going to generate 10 CR, so B is also expecting that project is going to generate 10 CR. Both have same expectations. So the first step of valuation is constant for all investors. All investors are expecting that the project or the company which we are valuing is going to generate the same cash flow for all investors. Number two, perfect capital market. Again, a very difficult thing in the present scenario. There will be always asymmetric information between various participants. Few will have higher information, few will have lower information. But still, because of connectivity, we may say that the information efficiency is improving and all are having almost equal information now. So everyone has same information. This is the core reason for perfect capital market. No transaction cost. Now this is an important thing, because there are no flotation costs. Company can issue equity or debt without any flotation cost. Investor can buy equity or debt without incurring any brokerage. No taxation. No income tax. We are talking about income tax. Of course, GST is, or the goods and services tax, or the indirect tax is not a burden of company. It is the burden on the purchase consumers. Company is just an intermediary. So we are here talking about income tax. And what assumption they have taken? They have taken no taxes, which is going to be improvised in the second part, that is with taxes. Because these assumptions are actually limitations of this theory. Without these assumptions, the theory is useless. Next, no bankruptcy cost. Bankruptcy cost is associated with financial distress. What is financial distress? It is uncertainty that the issuer will be able to meet out its future obligations or not. If the uncertainty is going to increase, it is going to create some direct, indirect cost on the issuer, company. So they are assuming that there are no bankruptcy costs. There are no cost of having the financial distress, which is not again true. And this will be improvised in the next theory, which we are going to take in the next video. That is your static trade-off theory. We have that in our course also. So limitation improvised in the later part. That is why I am saying this theory becomes the base for a starting point for capital structure theories. Next, risk-free rate. Investor can borrow and lend at risk-free rate. Any amount you can borrow and lend at risk-free rate. So there are no risk premiums, liquidity, maturity, or other factors, risk premium. Again, assumption. It means what we can do is we can alter our position. If company is not taking leverage, we can take leverage and invest in the company. It's automatically an indirect leverage for the company. So again, an assumption. Next, no agency cost. What is agency cost? It is related to the relationship between principal and agent. It is assumed that agent should be keeping a principal agent ahead of his personal interest. And if he is not, this is a agency cost to the principal. Who are the agent here? The executives. Management is the agent for investors, because in company, ownership and management are separated. Equity holders are agent for debt holder. Both are investor, but control is with equity holder for decision making. We are assuming here that there is no agency cost, means all agents are working in the interest of their principals. Again, independent decision, the last assumption. The financing and investing decisions are not impacting each other, are independent decisions. It means from what source you are getting the finance and where you are investing, these are two separate decisions, they are not connected. We know that whenever a company issue or raise debt, in the debt issuing document, generally certain covenants are put, affirmative and negative also. Even in case of equity also, equity shareholder can put constraint that this amount should not be used for XYZ project. So practically there are constraints, there are relationship between investment and financing decision, but here we are assuming there are no connection between them. So with these five assumptions, our theory starts that it approach without taxes. What this theory says, the first proposition, what I have already told, that first proposition will be always related to valuation and WACC, and second is always related to your cost of equities. In both the theories, without tax and with tax, there are two proposition and the same order is followed. First proposition, it says that VU should be equals to VL. Now what is VU? VU is equals to value of unlevered firm. Unlevered firm, that is 100% equity, and VL is value of levered firm. The theory says that the first proposition says that without taxes, the value of unlevered and value of levered overall firm combined from debt equity combined point of view, it's same. The theory says that, and it proves using the arbitrage concept and homemade leverage concept that we are going to cover later, that sum of part must be equals to whole. So if this is a pie and it is 100%, if you slice this pie into two parts, equal part, 50 and 50, and again add these two parts, combine these two parts, again you are going to get 100. 40, 60, again add, it will become 100. So sum of part must be equals to whole. So just by splitting the capital employed, 100% unlevered, 50-50 debt equity or 60-40 debt equity, by splitting the capital structure, your value of firm is not going to change. That is why this theory is called as capital irrelevance theory. Why it is that the value of firm is not derived or dependent on from where you are raising the finance. It is dependent on where you are investing your finance. It is not related to the liability side of the balance sheet. It is related to the asset side of the balance sheet. Valuation is of assets, not the liabilities. Liabilities are representing the value of assets. Liability per se are not having any value. That is the fifth assumption, that independent as a relationship between the financing and investment decisions. Valuation is based on the cash flow, what your projects are going to generate. The firm's value is based on the cash flow. It's not based on the from where the firm got the finance. We are doing the value of firm. So value is of the cash flow what firm is going to generate. This is the second proposition. Value of firm is solely determined by the future cash flows, expected cash flows, not by the source of finance. And the third thing, without taxes, WACC is constant. Now, why it is constant? The answer is in proposition 2. Under certain assumption, of course, assumption we have already done. Under certain assumption, a company's choice of capital structure does not affect its value. Sum of part must be equals to whole. That is, if you split a pie in any ratio, the total will be always equals to 100%. Manager cannot change a company's value by simply changing the capital structure. Overall valuation of the company is not going to change. overall valuation of company is not going to change by changing the capital structure. Firm value is equals to firm value. How we derive the value of any asset? First step, find the future cash flow. Second step, find the required rate. Discount future cash flow by that required rate. That is the value. The sum of those present value is the value of the asset. Same way, firm is going to be valued. The firm value is equals to the present value, the discounted value of firm future cash flow discounted by its overall cost of capital, overall required rate of return of both debt and equity investor, because we are valuing from the overall firm point of view, debt and equity holder combined point of view. Why it is? Because of reason they are saying at homemade leverage argument. We do not have the practical question, but theoretical part we have. What is homemade leverage and what is the concept of arbitrage? I will come to that part later, but first let's go into the numerical part. What it says, under certain assumption, VU and VL will be always constant, because value of firm is dependent on the future cash flow and WACC is constant. Now, why WACC is constant? It is saying, the proposition 2 is saying higher leverage. Higher leverage means more financial leverage, degree of financial leverage, which is based on debt equity ratio. How much more interest cost you are committing in your income statement. DFL, degree of financial leverage, is your change in EPS with respect to change in your operating income. And why this DFL will increase? Because as you increase your interest commitment, your DFL will rise. And DFL shows the risk for equity investor, change in EPS, sensitivity of EPS with respect to with change in your operating income. How much your EPS will move, your equity holders earning will move. So as the uncertainty increases for equity shareholder, why it will increase? Because you are committing more interest. So higher leverage, committing more interest, your leverage will increase, your risk for equity holder, sensitivity of EPS will increase. So your risk of equity shareholder will increase, raises cost of it. And when risk is going to increase, as an investor, I am going to expect more reward. So equity investor will raise their cost of equity, and this is not going to affect. Higher leverage raised cost of equity but does not affect WACC or firm value. WACC change nahi hoga, because when firm value change hoga, firm value is based on two things. Number one, constant cash flows, and number two, future cash flows, and the WACC. We have already taken certain assumption, homogeneous expectation, same future cash flow expected by all investors. And future cash flows are dependent on assets, not the source of finance. So that is constant, that is okay. It is not affected by capital structure, but it is also saying that WACC is also not going to change. WACC is the weighted combination of cost of equity and cost of debt. There is no taxation, so I'm not taking after tax word here. So it is the combination, weighted sum of your cost of equity and cost of debt. ROA is equals to overall cost of capital, overall required rate of return is equals to RE multiplied by weight of equity plus RD multiplied by weight of debt. It is the weighted sum of debt and equity. Why this is not going to change when your RE is increasing? Of course, the sum of weight is equals to 1 when one component is increasing. So the answer is in second part. It says increase in cost of equity must exactly offset. Yes, your RE is going to increase because equity holder is feeling more risk. He is asking more reward. Expectation is increasing. But it is exactly offset, that higher increase in cost is exactly offset by greater use of the cheaper source of debt. Debt is going to be cheaper. Why debt is going to be cheaper? Because debt holder is having less risk compared to equity holder. He is getting priority in payment. Of course, for interest also, as well as when the company will be liquidated. So when he is having less risk, he should be asking less returns. What this theory says, as you increase your debt equity, your x-axis is debt equity. As you increase your debt in your capital structure, your debt which is having a lower cost, and this lower cost is going to benefit. Lower cost is going to benefit in the form of decrease in WACC, but at the same point of time, your WACC will also shoot up. exactly to offset the benefit of lower cost, cheaper debt in the capital structure. So RE is increasing. As you increase WD, of course, your weight of equity is increasing. This is constant. And if RD is constant, so your benefit of cheaper source is getting exactly offset by increase in RE. And that is why your WACC is also going to be constant. So if your future cash flow of assets is constant, your discounting rate WACC is constant. So present value of those future cash flow is also going to be constant. So value of firm, whether it is a levered or unlevered, the overall, from overall point of view, debt and investor combined point of view, it is going to be give the same present value. So that is why this theory says capital structure decisions are irrelevant. Whatever capital structure company wants to have, they can have. This is not going to affect the valuation of firm or the valuation of investors. Why this is going to happen? Here they have why value of levered and unlevered will be same. Here they have taken the concept of homemade leverage argument and concept of arbitrage argument. Theory demonstrates that change in capital structure does not affect firm value based on investors based on investor being able to create any capital structure. Investor being able to create any capital structure. Why they are able to create any capital structure? Capital structure is of company. How they can create capital structure? They say that if investor want that company should be using leverage and company is not taking leverage, then what investor can do is he can take personal leverage, your third assumption, risk-free rate. He can borrow at any amount at risk-free rate. He can borrow from at risk-free rate and invest in the equity of the company issuer. Automatically, it is an indirect way. The leverage is going to the company as a finance. Of course, for company, it is equity, but ultimately it is coming from debt. Investor is able to create any capital structure by borrowing or lending in the at risk-free rate. If they wish for a company by simply borrowing or lending themselves in addition to owning a firm's share. Next, using the concept of leverage, arbitrage. Now, what is arbitrage? Arbitrage is simultaneously buying undervalued and selling overvalued to create a risk-free overvalued asset to create a riskless or risk-free profit. That is the arbitrage process. Undervalued sell करिए, undervalued buy करिए and overvalued with same risk class sell कर दीजिए. Automatically overvalued पे आपको higher inflow होगा और undervalued पे आपका lower outflow होगा, तो you will get a savings. Using the concept of arbitrage, we do not have that practical question, but theoretically we can understand. Using the concept of arbitrage, if VU is not equals to VL, so if VU is greater than VL, your unlevered value is higher than your levered value. Both are generating same risk class, same company, same industry, same asset level, same sales level, same variable cost, same contribution, same fixed cost, so same EBIT. Till EBIT, their future cash flows are constant. After EBIT, of course, value of, in case of levered firm, there will be an interest cost. And by some reasons, some inequilibrium happened in the valuation. Your VU is greater than VL. Since both are generating same cash flows and risk level of the company is same, as an investor, if I am an investor of a overvalued firm, in this case, U is the overvalued firm. What a rational investor is going to do? He is going to sell the shares of VU, unlevered company. Sell all those shares, generate cash and invest complete amount in the levered firm, and levered firm is undervalued. So you will get the same control at a lower cost. If you have 10% control in the unlevered, sell those 10% shares and go and invest in the levered firm. In its debt and equity securities, 10%. still you will have some more amount left in your hand because you are selling higher price share and you are purchasing lower price share and investing in the debt of the company. Of course, the ultimate return will be same because future cash flows both companies are generating same. Risk is same. Operating risk is same because both belongs to same industry, same having same fixed cost in their cost structure. So what you have done, you have achieved higher, say at same risk, you have achieved same cash flows, inflows, and you have got some surplus also, which you can invest somewhere to generate some riskless profit. By moving from U to L, you as a rational investor, we are making profit, and everyone will do this in the market because there is an information efficiency. And if there is an information efficiency and everyone is going to do this, so everyone is selling a company U's unlevered company shares. Shares are in the market. Supply will increase. Supply will increase. The prices will come down. Overpriced share will come down. And now everybody is investing in L company, that is a levered company. So the demand for those share will increase. Automatically the prices will up, and this this arbitrage will continue till these VU and VL come to an equilibrium level. Let's go for the reverse case. VU is less than VL. These are the arbitrage scenarios. We are not doing in mathematical form. We are just creating a situation. Of course, this can be done mathematically also. So let's say the second type of inequilibrium where levered company is overvalued, and of course the arbitrage can be done by only the shareholder of the overvalued firm, because only holder can sell it. So if L, that is levered company, is overvalued, as an investor of L, equity investor of levered company, I will sell my share, overvalued firm share, let's sell it, generate liquidity, borrow at risk-free rate, because to continue with the same percentage control, you need additional fund, and we have taken assumption of risk-free rate of return, borrowing and lending. Borrow from the market, you borrow from the market on your personal basis, add that with your sale proceed, what you have got from by selling the share of a levered firm, and invest in the unlevered firm, which is already underpriced. So ultimately, you will get the same control in the unlevered company at a lower outlay. So you will left with certain surplus, which you can invest in risk-free rate, or you can return it, and you will save or have extra returns. At same risk, you are getting extra return. So everybody, it's a perfect capital market. Everybody is having this information that there is an inequilibrium. So everyone who is every person who is an investor, equity investor of levered company, is going to sell his shares. There will be supply of these shares. The prices will come down. The overpriced L company share will come down, and everybody is purchasing company unlevered company shares. So demand is increasing. The prices will come. So the inequilibrium will be restored to equilibrium level. So using this concept, whole concept, theoretical concept, approach without taxes gave two propositions. Proposition number 1, WACC is going to be constant. Reason is in proposition 2. Value of firm will be always constant, whether unlevered, levered, whatever is the capital structure, because value is dependent on future expected cash flow, which is generating from asset, nothing to do with the source of finance. And WACC is going to be constant. The reason is given in proposition 2. It is because when you increase your leverage, debt in your capital structure, of course, equity investor is going to feel more heat. He is going to feel risk. He is going to increase his cost of equity, but this cost of equity increase is going to push WACC higher, but this push will be offset by the benefit of lower cost debt. So ultimately, your WACC will be constant. So if your future cash flows are constant, your WACC discounting rate is constant, your value of levered, unlevered will be always same. And if due to any reason there is an inequilibrium, that inequilibrium will be restored to equilibrium by using the arbitrage. And for doing arbitrage, if you need any additional fund, or if you are left with any funds, you can borrow and lend at risk-free rate. You can create your homemade leverage. If company is not taking leverage for investing in the second scenario, I am having short of funds. What I can do, I can borrow. I can create homemade leverage for myself. So these are the theoretical part. Let's go for the numerical calculation. Calculation. What is the question we have? The question says that the following data relates to two companies belonging to same risk class. So same risk class means operating risk, business risk is same, sales risk is same. So their sales, their variable cost, their contribution, their fixed cost and their EBIT, earning before interest and tax, is same. So we have got our EBIT or cash flows. We have got our cash flows. Equal cash flows are generated by these two companies, 18 lakhs and 18 lakhs. Now, company A is a levered company. Company B is an unlevered company. There is no debt. Company A is having 12% debt of 54 lakhs. Company B, being an unlevered company, its starting cost of equity capitalization rate is 18%. A Limited's cost of equity is not going to be 18%. It is a question mark. As the debt is going to increase, cost of equity will increase. That is the proposition 2, to offset the benefit of cost of debt. There are no taxes. First of all, we are going for first question. As per approach without taxes, what is the total market value of both the firms? What is the cost of equity? Of course, for A Limited, B already we have. And what is the WACC of both the firms? Let's calculate this. So first, for B Limited, the starting point will be always your unlevered firm. Next, we will take the approach with the taxes also. So solution. First, approach without taxes. So today we have done a theoretical approach, but very important from exam point of view. You can get different type of question, theoretical as well as based on assumptions, based on proposition, based on reasoning of proposition, and of course numerical also. Approach without taxes. So first, step number 1. Step 1. Always calculate value of unlevered firm. Value of unlevered firm. Unlevered firm, that is your what? B Limited. Value of firm, here your cost of equity is equals to your overall cost, that is your WACC. They are same because it's a 100% equity company, so weight of equity is 1, so cost of equity is equals to your cost of overall firm. What is value of firm? Value of firm is your EBIT, your cash flows discounted by your WACC. It is equals to overall cost of capital. So it is equals to 18 lakhs divided by how much? 18%. We have got a value of 18 lakhs. So it is going to give 1 crore. 1 CR is the value of firm. Now, step number 2. Value of levered firm. A Limited, which is this A Limited has introduced debt in its capital structure 54 lakh at the rate 12%. Value of levered firm as per approach without taxes, because of arbitrage. If there is an inequilibrium, your rational investors of equity investor of overvalued firm will start doing arbitrage by selling their share and investing in the other firm, and they will do until the equilibrium is reinstated. So value of levered firm will be always equals to value of unlevered, that is equals to again 1 CR. This is value of overall firm, that is B Limited. Value of A Limited now. A Limited will be also 1 CR, and if there is any difference in equilibrium, The arbitrage will start and it will continue till both the firms have the same value by taking the homemade leverage. Let's so what will step 3? Value of equity for B Limited unlevered firm, it is equals to the value of firm itself 1 CR because there are no debt. But for A Limited, which is a levered firm, the overall value is 1 CR minus 54 lakh of debt. The valuation is 46 lakhs. Value of equity. Next, now what they wanted, total market value we have already got. Now they want cost of equity. Cost of equity, step 3, valuation done. Now step 4, equity capitalization rate. For B Limited unlevered firm, it is already given. Because this is the starting point of our question. It is 18%. But for A Limited, now how to calculate it for A Limited, that is important. Yes, we have a formula. From where this formula came? We do not have a derivation in our course. How to derive this formula? What is the formula? It says that, proposition 2 says that as you increase the leverage, cost of equity is going to rise. And it is going to offset the benefit of cost of debt, cheaper source benefit, cheaper source introduction benefit. But what will be the new cost? So they have given a formula. The formula says RE, that is cost of equity, is equals to RO plus RO minus RD multiplied by D upon E, where D and E are the market values of debt and equity respectively. Now, from where this formula is derived? This formula is from the same formula, that is WACC, what we have got. The derivation says that RO is equals to RE multiplied by weight of equity plus RD multiplied by weight of debt, correct? RE equals to RE multiplied by E upon your E, value of equity, upon value of firm, which is E plus D. And RD is multiplied by D upon E plus D, the overall value of the firm, that is the formula weight. Cross multiply, RO E plus D is equals to RE multiplied by E plus RD multiplied by D. Let's open the bracket. So we got RO multiplied by E plus RO multiplied by D minus RD multiplied by D is equals to RE multiplied by E. So RE equals to, now what I am doing is, this is your RE multiplied by E. So I am dividing both sides by value of EE, which shows E is your market values. These are market values of D and E respectively. We are dividing it by E. So it is RO plus RO multiplied minus RD. Let's take it D common, whole divided by E. And this is the formula what they have given in our study mats. So this is nothing new. This is derived from your original formula of WACC only. So RE, that is cost of equity, this is cost of equity, is equals to your overall cost plus overall cost of unlevered. This is your cost of debt. And these are your market value of debt and equity respectively. So let's put this formula for A Limited. For A Limited, RE equals to RO plus RO minus RD multiplied by D upon E. So this is equals to 18 plus 18 minus, what is the rate of interest? 12%. 12 multiplied by, what is the value of debt? 54 lakhs. What is the value of equity? Market value of equity we have already got 46 lakhs in step number 3. 46 lakhs. Let's solve this. It is 54 divided by 46 plus multiplied by 6. So it is going to give 18 plus 7.0435, that is equals to 20 plus 7.0435 is equals to 25.0435%. This is your cost of equity for your levered firm. Step number 4. Now, next part, what is the WACC? So, WACC in case of step number 5, WACC is equals to weight equity, cost of equity, weight debt and cost of debt. So, for B Limited, WACC is equals to your 18% because it's 100% equity. And for A Limited, if you put values, cost of equity, weight of equity is 46 lakhs over 100 lakhs multiplied by, what is the cost of equity? 25.0435 plus, what is the weight of debt? Debt is 54 lakhs over a value of 100 lakhs, the value of firm debt plus equity multiplied by your 12%. So again, from the same formula, we have calculated cost of equity. So if we put that cost of equity in the formula WACC, it should come 18%. It should, multiplied by 0.46 and 12 multiplied by 0.54 plus. This is again giving us 18%. So both WACC of levered and unlevered is same. Value of firm for levered and unlevered is same 1 CR. Only cost of equity is going to rise from 18% to 25.0435%. What we can say, this is a equation, and this equation, if we see the format of this equation is y equals to a plus bx. This is a linear equation. So cost of equity is following a linear relationship where your intercept is your overall cost of equity and your slope is your cost of overall cost of capital, and slope is overall cost of capital minus cost of debt, and your independent variable is your debt equity ratio. So let's see what text is saying. Text is saying that higher financial leverage raises the cost of equity. Of course, we know that risk is going to increase. So cost of equity reward expectation is also going to increase. Adding financial leverages increases risk for equity investor. Thus, they demand higher return on the equity to offset the increase in risk. Since my risk is increasing, I need higher return. That is why that is the justification for increase in KE, your cost of equity. Theory tells that adding amount of lower cost debt capital is always perfectly offset by increase in the cost of equity, resulting in no change in WACC. What they say is cost of equity is increasing, benefit of debt is coming, both are offsetting exactly each other. It implies that cost of equity is a linear relationship of its debt and equity ratio, and that is why this RE, this red line is showing the cost of equity, and it is starting with the point of first point at the unlevered, because this situation 0 means unlevered, there is no debt. At unlevered, your RE and RO are same. For unlevered firm, RE cost of equity and RO overall WACC is 18%. And as you increase your debt in the capital structure, from 18 it will move higher to 25 point. For 54 lakh rupees, your debt in your capital structure, 54 lakh upon 46 lakhs, your this cost of equity will increase from 18 to 25.0435. 25.0435. So this is the MM approach without taxes. Next part, we will take MM approach with taxes, again complete theory, complete reasoning, and then a numerical question with the steps how to solve the numerical questions of MM approach with taxes. Thank you so much.